Thank you for joining me on this video. My name is Rodney Constable. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand both the direction of the trend and the level of risk in the stock market through our proprietary indicators that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, July 31st, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. This week we were up 1.73% on the S&P 500 and closed at 3271.12. And let's start over here on the right of this chart. And by the way, this is a one-year weekly candlestick chart of the S&P 500. I have a lot of annotations on this chart that I will go over for you. But the first thing that I want to point out is that we've now had 3 weeks in a row where we have closed above 3,200 on the S&P 500. And this is only the 13th time in history that this has been accomplished. The last 10 times that we did this were towards the tail end of 2019 and beginning of 2020. And of course, earnings were much higher on the S&P 500 at that point. $162 per share were the earnings for 2019 on the S&P 500. And for 2020, we're going to be lucky if we can come in somewhere between $120 and $130 per share on earnings for the S&P 500. So what this tells us is that we are accomplishing the price action. We're closing above 3,200 on the S&P 500 at a much higher price to earnings ratio with much lower earnings per share than we had last year. So that is just something to keep in mind. Yes, the price action is great. It's wonderful that we're doing this. However, the cost, if you will, the price that we are paying is that we are taking more risk as investors because we are paying more for a dollar of earnings now than what we were just about 7-8 months ago for the same price level. So just kind of keep that in mind. This orange line here, by the way, is the 40-week moving average. Of course, the 40-week moving average is equivalent to the 200-day moving average, and it's just a key barometer that anybody on even a free charting site like Yahoo or something like that, anybody has access to the 200-day moving average. In this case, we're using the 40-week because it's a weekly candlestick chart. And the blue line there should be pretty apparent at this point, but this is the 3,200 level on the S&P 500. And as we can see here, this really is a key support area. It acted as overhead resistance at the tail end of May, beginning of June. As we can see here, we got initially rejected, rolled back over, and went down towards the 200-day moving average. And then once we were able to get back above the 3,200 level and start to close above 3,200 on a weekly basis, you can see that we've consistently done that now for the last 3 weeks. So fingers crossed that we keep closing above this 3,200 level. But keep in mind, guys, and I'll probably repeat this a couple of times throughout this presentation, we are going into what is traditionally the worst 3 months of the year in the stock market. Not every year, of course, but we've got August, September, and October, and it's very rare that you get through that 3-month time frame without some type of a sell-off. It could be 3 to 5%, it could be 5 to 10%, but one of those months, generally, if you go back over, the decades, one of those months you generally experience some type of a pullback. And keep in mind, we're just a little bit more than about 3 months out on a what's probably going to be a contentious presidential election. So that in and of itself is going to cause some volatility, and the next couple of charts that we're going to look at will also let you know that there's probably a little bit of froth in this market. So it pays to be a little prudent here, I do believe. The next chart that we're looking at here is a 2-year weekly candlestick chart of the triple Qs. The triple Qs, of course, is the NASDAQ 100. That is the ETF that tracks the NASDAQ 100. The NASDAQ 100, of course, a lot of biotechs, technology, and some very high beta stocks in that index. And what we can see here is the index closed up a little over 4% for the week. And if you can see over on the right where my cursor is circling. We actually closed at an all-time weekly closing high on the triple Q, so that's great news. However, I do want to point out that we're trading a long ways above, as we can see here, the blue line. That's the 40-week moving average on this chart. I just made it blue on this one, but you can see we're trading a long ways above the 40-week moving average on the triple Qs, and whenever you get this far above a long-term moving average, especially on a basket of stocks, it's just a matter of time before you roll over and pull back to or towards anyway that 40-week moving average. It doesn't mean you're going to come all the way down to it. Sometimes you do, sometimes you don't. But given the fact that we've come a long way in a short period of time, technology is really the thing that has, for the most part, held up this market. Not a lot of other sectors have been working all that well. The technology sector has, for the most part, not been negatively affected, and in some cases perhaps even been positively affected by the shutting down of the economy due to the coronavirus, because people have had to turn to technology in place of doing things face-to-face. But this trend will not go on forever. We cannot have these types of run rates in the technology sector or the triple Qs, and we'll take a look at the tech sector within the S&P 500 next. But I just want you to understand that this is it really is an unsustainable gap here, guys. We are going to pull back at some point towards this 40-week moving average. Will we get all the way down to the 40 or below? I don't know. There's no way to know that. But going into what is traditionally the worst 3 months of the year with this type of an extension and all of the uncertainties that are ahead of us over the next few months, with the coronavirus still spreading, the election, we don't know what's going to go on with the next stimulus package, what that's going to look like, how well that's going to be accepted by the markets. And also keep in mind that, and this is the geeky part of me, my finance background, but we should expect diminished marginal returns on future economic stimulus plans. In other words, a lot of this is going to be baked into the cake already, and when a new stimulus comes out, we shouldn't expect it to have the same impact on the stock market and the economy as what previous stimulus plans did. So hopefully that made some sense. I know that was a mouthful, but just kind of keep that in the back of your mind as we move forward here. But keep in mind, again, that gap there is wide, and it's probably unsustainable. And when we turn our attention to the XLK, which is the ETF that tracks the technology sector within the S&P 500, you can see that this gap looks very similar. It's not quite as wide as the triple Qs, but we still have a very wide gap there. The XLK was actually up a little bit more than the triple Qs this week, up exactly 5% for the week. So a very, very healthy gain in the XLK. The XLK also, like the triple Qs, closed at an all-time closing high. So again, we've got massive gains. And if you just looked at these last two charts, you would never know that there's been, that the economy, that we're actually in a recession, that there's, 10+% unemployment, that we have a pandemic. You wouldn't even know that. And so that is something to keep in mind, that yes, these charts look fantastic, but it's probably not sustainable. We're going to get some type of a pullback here at some point, probably over the next few months. And keep in mind that the tech sector within the S&P 500 is the largest sector. It's the most heavily weighted sector within the S&P 500. So that's why it's so important to understand the tech sector and what's going on there, because when the tech sector pulls back, it will have a negative impact on the overall S&P 500. It has to, because it is over 25% of the S&P 500 is just that one sector. It is the most heavily weighted sector. It is the most important sector within the S&P 500. So it pays to pay attention to the XLK and what is happening there. Yes, it's performed very, very well over the last few months, over the last few years. But again, this type of a run rate, these 5% weeks don't come around very often. This gap over and above the 40-week moving average, this gap will be closed at some point in the future. And when it does close that gap, by rolling over and stalling, or at least trading sideways, in the S&P 500 and the overall stock market will be fighting some headwinds for sure. The next chart that we're looking at is for the IWM. That is the ETF that tracks the Russell 2000 small cap index, 2,000 small caps here in the United States. What we can see is that the small caps eked out a small profit for the week, up 0.87%, so 87 basis points. And we can see that the small caps have closed for 3 weeks in a row above their 40-week moving average. But I do want to point out that that is a downward trending 40-week moving average. So the 40-week, again equivalent to the 200-day, has come down to meet the price action of these small caps. And it does pay to note that the Russell 2000 index, this ETF, is trading at 2017 price action. So if you go back to Q4 of 17 here, we can see that where we're trading at right now is the same place that we were back in Q4 of 17. So we haven't made any progress in the small caps for over 2.5 years, okay? The small caps peaked here in the United States in August of 18. We tried to come back and challenge those highs back at the end of 19, beginning of 20. That failed and started to roll over actually a month before the S&P 500 rolled over. So, just understand that your strongest stock markets, your strongest rallies in the stock market, the most sustainable rallies in the stock market, things that look like this, is when you have small caps trading along with the large caps. We cannot have a healthy stock market with just large cap tech holding everything else up. So just keep that in the back of your mind, guys, that these markets are not quite as healthy as most people want to believe. There's a lot more risk out there than most people want to believe. And again, we are going into what could be a very volatile period over the next 3+ months. Now what we're looking at is a chart of the S&P 500 for the first 3 months of 2020, so January through March. And I've annotated this chart with these simple market signals to show you how simple market signals can help you understand the risk levels and the changing risk levels in the stock market, and how simple market signals can help you manage your risk. The simple market signals are green, yellow, and red. Green is the lowest risk level in the stock market, and what you're going to find is the stock market makes most of its upward progress when the signal is green. When the signal is yellow, that means that risk levels are starting to rise, and what we can expect in a yellow environment is sideways to slightly up or down price action. And the red signal is the worst signal in the model, and you're going to find that the worst sell-offs, including bear markets, happen when the signal is red. So let's walk through this and see how this works. So we came into the year with a pretty strong stock market, as we know, and the signal was green for the majority of January of 2020. On the 27th, the signal went to yellow, and we had a yellow signal for about 2 weeks here. As we can see here, the signal went back to green for a few weeks. We know that we hit our all-time high in the stock market on Wednesday, February 19th, 2020, where the S&P 500 closed at 3386.15. And then we had this negative reversal that I had talked about in my newsletter to my subscribers, and I had told them that I did not like this price action because we did not have the follow-through. We hit that all-time high in the stock market, and then we had this negative reversal, sold off on Thursday and Friday. And so in the newsletter that went out on Saturday, February 22nd, I was warning my subscribers that I felt like something was changing and that they should be ready to take defensive measures and protect profits. And sure enough, the signal went yellow on Monday, February 24th. So I hope you guys are paying attention to how this can really help you manage your risk. And think about what happened here, okay? We hit an all-time high in the market, and then just a few days later, the model showed that there was rising risk, and the signal went yellow on the 24th. Now, over and above the risk signals, I have trend indicators in this model. The longer-term trend indicator, called the general trend indicator, went negative the very next day on 2/25. Okay, so the signal went yellow, right, on Monday the 24th. On Tuesday the 25th, the general trend indicator went negative. So there's two warnings right there, right, that something is not right in the stock market. And by the way, the general trend indicator had been positive since October of 2019, okay, since early October 2019. So think about that. The signal went yellow. The very next day, the trend indicator went negative. That trend indicator had been positive for months. Okay, so there's numerous ways that simple market signals can help you manage your risk. So there's two things right there within 2 days that could have told people that they probably should take some profits, rebalance their portfolios, take defensive measures, buy puts, however you want to protect your portfolio, right? That's up to you. But you can see here how this is working. And then by Thursday, the 27th, the signal had gone red, okay? And by the way, that signal went red at around 3,000 on the S&P 500. And your first warning came out at about 3,250, okay? So, and the second one came out somewhere, around 3,100. Let's just call it 3,100. So you had numerous warnings all within 1 week. You had a yellow signal. You had a negative general trend indicator. Again, that thing had been positive for months. And then the signal went red. And as we know, the market sold off very hard from there. Guys, this is just one example, but a very recent example of how simple market signals can help protect you, okay? And regardless of whether you're trading the S&P 500, the DIA, the triple Qs, individual stocks, the correlations in the stock market they're so high these days that if you understand what's going on with the S&P 500, and my model is based on the S&P 500, but if you can understand what's going on with the S&P 500, irrespective of what you're trading, it will help you understand the general direction and the general risk levels in the stock market, okay? Because as we know, 70, 80, 90% of all stocks go in the same general direction as the S&P 500. So if we can understand what's happening with the S&P 500, it gives us a huge advantage in trying to manage our risk and protect our profits with our investments. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.